Hey everyone, thanks for checking out this video. My name is Travis Rose. I'm the creator of the Master the Market education that you can find linked below in the description. And this is going to be part 3 of the Day Trading Stocks for Beginners series. So if you're someone that's brand new to the market, you may want to start off by watching part 1 and part 2 before we move on here to part 3. But anyway, in this one, we're going to actually start getting into some technical analysis, which is going to help you be able to read price action and look at charts to actually be able to predict future price action. And hopefully that will, of course, lead to some profits. So first and foremost, what is the difference between technical analysis and another type of analysis that we'll talk about in the future of this series, which is known as fundamental analysis? Technical analysis is the analysis type using patterns in the market data to identify trends and make predictions. So anytime somebody mentions things like chart patterns, indicators, candlesticks, volume, and so on and so forth, all of these things are part of technical analysis. Okay, and this is going to differ again from fundamental analysis because fundamental analysis is the analysis using a business's actual financial statements to predict future price movement. So when you think about things like revenue, operating expenses, net profit, and so on and so forth, typical things that you would see on a company's balance sheet, all of these are part of fundamental analysis. And when it comes to longer term investing, you want to find stocks that have strong fundamentals and that have growing financials because those are going to make better longer term investments. Now, since we're focused on just day trading rather than longer term investing here in this series, you're actually going to see that fundamental analysis isn't going to be quite as important for day trading, but there are definitely some things that you're going to want to look into when it comes to fundamentals, and that's what we're going to talk about in the next video of this series. So with that being said, the first part here with technical analysis, this has to do again with the charts and the volume and the different chart patterns that we see. So what makes up those chart patterns and makes up the charts themselves are what are known as candlesticks. And a candlestick chart is just a common chart style used to describe price action over a set period of time. So for example, you can have a 5-minute chart, and that means that each candle on the chart represents 5 minutes of price action. A 1-day or a daily chart means then that each candle is going to represent an entire day of price action. So if we take the example down at the bottom of the screen, this is stock GNPX, and we're looking at the 1-day, 1-minute chart. So what that means is each candle is representing just 1 minute of price action, but we're looking at the span over an entire day. Okay, and again, these candlesticks are what make up the charts themselves, and basically because of that, they're going to be kind of the foundation of any technical analysis that you're doing to be able to predict future price movement. So with that being said, it's important that you're able to understand how these candlesticks are made and at the end of the day, why they look the way that they do. So we know that, of course, if it's a green candlestick, that means that it closed at a higher price than it opened. And if it's red, we know that it closed at a lower price than it opened. And again, this can be over any set period of time. So if we're just looking at the 5-minute chart, a green candlestick just means that it moved up within that 5-minute period. And if it's red, it just means that it moved down within that 5-minute period. And the colored part of the candlestick, the one that we're talking about, either being green or red, is what is known as the real body. Aside from the real body, there are 2 lines that stick out from the top and the bottom of these candlesticks. The one that sticks out from the top is known as the upper wick, and this is going to show us how high the price went within that period of time. And down there on the bottom, you can see that there is the lower wick, and that's going to show us the lowest point that the stock went within the period of time before that candle closed. So for example, if the stock opened at $1 and then closed later on at $1.10, we know that that would of course be a green candle, but that doesn't necessarily mean that the stock went straight from $1 to $1.10 before closing. It may have went down to 98 cents and then spiked all the way up to $1.15 before coming down and closing at $1.10. So that's how the real body and the upper and lower wicks of the candlesticks are actually made up. And once you get into some technical analysis and you're able to actually read these candlesticks, all of this information can be very helpful to actually find better trade entries and better trade exits. So that's going to lead us to the first chart formation. I wouldn't necessarily call this a chart pattern, but it's kind of a formation that we see, whether it be on a 1-minute chart, a 5-minute chart, or even a longer term chart like the daily or weekly chart. And that is what is known as support. Support is a price where a stock historically has a difficult time falling below due to increased buying or demand than selling or supply. And that's something very important to keep in mind. Many people don't really realize that the stock market moves pretty much solely based on supply and demand. A lot of people think that, when a company releases some kind of news, if it's a good piece of news, they think that that news is the reason that the price is going up. But really, the direct reason is because of the supply and the demand. That positive news that the company put out may affect the supply and demand, meaning that there is now more demand for the stock and less supply. But again, the supply and demand is what is going to directly affect the price of the stock. So again, at a level of support, we know that there is just more demand for the stock than there is supply, and that makes support levels a bullish area, and we can use this as an opportunity to possibly look to buy into the stock. So when you're looking at a chart and you see something like a flat horizontal line where the stock seems to bounce off of multiple times, that's pretty much what a level of support is going to look like. And because you know that there is a support level in the area and you know that there's plenty of demand for the stock, you can look to buy into the stock just above that support level, and many times that can lead to profits from the stock bouncing off support and continuing higher. Now, the nice thing about support is it also gives you an easy area to cut losses if the trade happens to move against you. And the reason for that is because if a stock breaks down below support, many times it's going to continue lower until new support is formed. So because of that, when a stock does break down below support, it's important that you cut your losses quickly and exit out of the trade and wait for new support to form before you buy back into the stock. And just to give you a real life example of what support looks like, here we have the stock symbol BLPH, and again we're looking at the 1 day 1 minute chart. So this is the span of an entire day, but each of these candles is again only representing 1 minute of price action. So the left side of the chart where it's gray in the background, that's actually pre-market trading, and then once the background goes to black, that's when the market opens at 9:30. And you can see that early on in pre-market, the stock seems to form a little bit of support right at about $5.50. When the market opens, the stock spikes up a bit to about $7.40 before coming back down and retesting that support at $5.50. And that's exactly where you would probably look to buy into the stock if you were using and watching this support level. And this is a perfect example because the support does hold and the stock is able to spike back up and actually break over the morning's high, later on hitting a high of $8.40. So it went up almost $3 per share just a few hours later after holding that support level. Now, like I mentioned, this isn't always going to be the case because unfortunately nothing is perfect in the market. There are times where things go perfectly, like in the previous example here with BLPH, but there are also times where support looks like it's going to hold and then immediately ends up breaking down below it. So again, just to remind you, you can also use these support levels as an area to cut losses if the stock does fail to hold the support. And what that may look like is down below, you see that the green dot on the chart represents where you would buy into the stock. You can see that there is a bit of support in the area, so it may look like a good buy opportunity. And then pretty much right away, the stock actually breaks down below that support. And again, that's exactly where you would want to sell out of your shares and cut your losses on the trade. And then just wait for a better opportunity to buy at a lower price, or just completely avoid the stock and move on from the trade entirely. Now, on the other side of the spectrum from support, we have what is known as resistance. And pretty much resistance is going to be the exact opposite of support. A resistance level is a price where a stock historically has a difficult time breaking above due to increased selling or supply than demand or buying. So a resistance level is then going to be considered bearish as opposed to bullish like support. And we can use these resistance levels as an opportunity to sell if we're currently in a long position, or we can actually look to short sell, which allows us to profit from the stock coming back down. So just like support, resistance is actually going to be a flat line on your charts, and you don't have to really calculate anything or do any kind of advanced stuff. You simply are able to see where these flat lines of support and resistance are, and all you have to do from there is just draw them on your charts. And again, in this case, you can use them to sell out of your position if you previously bought shares, or you can look to short sell, which then will allow you to profit from the stock failing to break above resistance and coming back down. And just as a reminder, if you want to learn a little bit more about short selling and how you can profit from stocks going down, that's something that I talked about in part 2 of this series. So I recommend checking that out if you haven't already. And again, that's going to be linked down below in the description. But anyway, you can see that in this diagram, the stock spikes up and seems to form a bit of resistance. And that's exactly where you would want to look to short sell your stock. or sell out of any current positions that you were in. And again, just to give you a real life example, we have AMD with the 1 day, 1 minute chart, and you can see right at about $55.40, the stock seems to form some resistance early on as soon as the market opens, and then later on throughout the day, it tests that level multiple times, and that is exactly where you would want to sell out of your shares, or even again look to open a short position. Okay, now again, just like support, resistance also can be used as an opportunity to cut losses. There may be a time where there looks to be a perfect level of resistance and you decide to short sell the stock, but later on it breaks above that resistance. And again, we want to cut losses immediately when a stock is breaking out above resistance, because a lot of times they will break out and then continue higher until new resistance is formed. So it's best for us to just cut our losses quickly and move on from the trade, and even look to possibly short sell again at a higher price once some new resistance is formed. Now, one very important thing about support and resistance that many people don't realize is that past support can become resistance, and past resistance can become support. So just because a stock breaks down below a level of support doesn't necessarily mean that you should erase that support level from your chart, because later on the stock could actually bounce back up, and that past support can now turn into a level of resistance. That's why, in my opinion, it's very important to actually keep track of major support and resistance levels and keep those lines on your charts, even if the stock has since broken through them. And just to give you an idea of what this could look like, over on the left side, we have a stock that has some resistance. Right in the middle on the green dot, that's where the stock breaks out above resistance. And then later on, it comes back down, and that past resistance is now acting as a level of support. And over on the right side, we have the complete opposite happen. We have a support level. In the middle of the chart, the stock breaks down below that support. Later on, it bounces back up, and that past support now turns into a level of resistance. And actually, if we go over to my Twitter real fast, just the other day we had a perfect example of broken support turning into a level of resistance. So we had the stock SLS that was spiking up in the morning, and it actually was halted for volatility at 9:38 in the morning. While it was halted, I simply looked at the daily chart of the stock, and I said that $3.75 is the next area of resistance. At the time, it was at about $3.30, I believe. And later on, just a few minutes later, once the stock resumed trading, it spiked all the way up to $3.71 before it came all the way back down and later on closed below $3. So the way that I came up with that $3.75 area is, if we look at the daily chart of the stock, you can see that on multiple different occasions, 375 was a level of support. Later on, the stock broke down below that 375 area, and here's the day that I tweeted 375 may now be a major level of resistance. You can see that the stock spiked all the way up and came just 4 cents from hitting that 375 area before it reversed back down. Okay, so even though it looked like the stock broke down below that support quite a while ago, it's still important to keep in mind that that was a major level of support at one time for the stock, and now that it's broken down, anytime the stock is spiking back into that level, it can now become a level of resistance. Alright, so I hope this video was helpful in being able to spot some different things like support and resistance on your own. And now at least you should have a good understanding of some very basic technical analysis, so that way later on in my channel, when we get into some more advanced topics and we start talking about some more advanced strategies, you're not going to feel lost and you can have a good foundation to build off of. So anyway, if you enjoyed, please make sure to give this video a like and subscribe to the channel so you don't miss out on part 4 of the series. And as always, if you want to learn everything step by step, from the absolute basics to the advanced trading strategies that I use to trade stocks full time, you'll learn how to day trade, swing trade, and even longer term invest. You'll be able to take 70 practice tests to make sure that you're actually understanding everything that we're talking about in the course. And you'll even be given access to our chat room with over 1,000 other active traders. All of that is included at Master the Market, which will be the first link down below in the description. Anyway, thanks again for watching. Good luck with your trading, and I'll see you in part 4.